Have you ever really stopped and thought about money? I mean, we use it every day, but where does it actually come from? Do they just print more of it? Well, the real story is so much more interesting than that, and it involves a little bit of, well, magic from our banking system. So let's get into it and figure out where money really comes from.
All right, just for a second, imagine a world with no money. Let's say you've grown a giant sack of rice, and what you really want is a new phone. How do you make that happen? I mean, you'd have to track down someone who not only has a phone to trade, but also happens to be in desperate need of a giant sack of rice, right at that very moment. It sounds kind of crazy, right? But this is exactly the huge problem that money was invented to solve.
So that system of just trading stuff for stuff is called bartering. And yeah, it might work if you're trading, I don't know, a couple of small things, but can you imagine our entire global economy running like that? It would be a total nightmare, just incredibly inefficient. And this whole core problem, it actually has a name that nails it perfectly. It's called the double coincidence of wants. Think about it. It's not enough that you want what the other person has, they also have to want what you have at the exact same time and place. The odds of that happening consistently? So low. All that time you'd spend just searching for the right person to trade with? Well, economists call those search costs, and they would bring an economy to a screeching halt. And this is where money comes in and saves the day. Money is that one thing, that middleman that we all just agree has value. You can sell your rice to anyone for money, and then take that money and buy a phone from anyone else. It's simple, it's elegant, and it makes everything work. But money is more than just a convenient tool for buying stuff.
See, for something to truly be considered money, it's got to do more than that. It actually has to perform 3 very specific jobs for the whole economy to function.
Okay, first up, it has to be a medium of exchange. That's the one we just talked about. It makes trading super easy. Second, it's a unit of account. This means it's like a universal price tag. We know a pen is worth 10 rupees and a pencil is worth 2, so it's easy to see a pen is worth 5 pencils. Simple. And third, it has to be a store of value. You can save money today and know it'll be worth something next year. You can't really do that with a sack of rice, can you? It's perishable. Money, on the other hand, holds its value. Well, mostly.
So, we have money. Fantastic. But that still doesn't answer our big question. Where does most of the money we use today come from? Because here's the thing, and this is really the key. The vast majority of money isn't just printed by the government, not even close. To understand where it really comes from, we have to go back in time and hear the story of a very clever goldsmith. Picture it, a small village, way back when. People used gold as their money. But carrying around clunky, heavy gold was risky and inconvenient. So they started leaving it with the local goldsmith. We'll call him Lala, because he had the strongest, safest vault in town.
Every time someone dropped off their gold, Lala would give them a little paper receipt. It was basically an IOU, a promise from Lala that said, "This note is good for this much gold." Now this is where things get really interesting. Pretty soon, instead of going to Lala, cashing in their receipt for the heavy gold, and then using the gold to buy something, people just started trading the paper receipts directly. I mean, why bother with the hassle? As long as everyone trusted Lala and his vault, that piece of paper was as good as gold. And just like that, the receipts themselves became a new kind of money.
And this is when Lala had his brilliant, world-changing idea. He's looking at all this gold just sitting there in his vault, not doing anything, and he has a huge realization. He thinks, wait a minute, what are the chances that everybody is going to show up on the exact same day to claim their gold? Pretty much 0. So he realized he could safely lend out a portion of that gold to someone who needed a loan, and he could charge them interest for it. And boom, that is the birth of modern banking. Think about it. The original paper receipts are still out there, being used as money. But now there's also this extra loan of gold out in the world also being used. Lala had essentially created new money, poof, right out of thin air. Now, I know that sounds like a quaint little fable, but what's absolutely wild is that our modern banking system works on this exact same principle. What Lala figured out all those years ago is the foundation of how money is created today. So let's see how it works. Okay, so let's say you deposit 100 rupees into your bank account. That's our starting point. Now, does the bank take that 100 rupee note and put it in a little box with your name on it? Absolutely not. See, every bank has to follow rules set by the country's central bank, like the Reserve Bank of India. The big rule for our story is called the cash reserve ratio, or the CRR. It's just a percentage that tells the bank, hey, out of all your deposits, You must keep this much in reserve. You can't lend it out.
Okay, let's watch this process unfold. In round 1, you deposit your 100 rupees. Let's say the CRR is 20%. The bank has to keep 20 rupees in its vault, but it can lend out the other 80. Now that 80 rupee loan doesn't just disappear. The person who borrowed it goes and spends it. And whoever gets that money, well, they probably deposit it in their bank. And that kicks off round 2. That loan becomes a new 80 rupee deposit. Their bank keeps 20% of that and lends out the rest. This cycle just keeps repeating, on and on, with each loan creating a new, smaller deposit somewhere else.
So what's the grand total after all this is done? Well, by the time this process, which is called the money multiplier effect, runs its course, your initial 100 rupee deposit has actually created a total of 500 rupees in the money supply. It's not actually magic, but it sure feels like it.
Now you're probably thinking, whoa, that is an incredible amount of power. And you'd be right. It can't be unlimited or things would get chaotic really fast. And this is where the referee of the financial system, the central bank, steps in to set the rules.
The central bank is a huge deal. Yeah, it issues the physical cash we use, but it's also the bank for the government, and it's the bank for all the other commercial banks. And most importantly for this story, it controls the entire money supply, mainly by tweaking that one powerful little number, the reserve ratio.
And this is really the key takeaway from all of this. Banks have this incredible power to create money just by making loans, but they can't go wild with it. That reserve requirement, that's the leash. It's the hard limit that stops them. By raising or lowering that ratio, the central bank can hit the brakes or the accelerator on the entire economy.
So if you remember just one thing from this whole explainer, let it be this. Banks are not just safe warehouses for your cash. They are active engines in our economy. They create the vast majority of money in circulation, all those digital numbers in our bank accounts, every single time they issue a loan.
And that brings us to one last, really fascinating question to think about. For centuries, this whole system has been built on the idea of physical deposits and loans. But now, as we move deeper into a world of instant digital payments, e-wallets, and even cryptocurrencies, how will this fundamental process of money creation change? What does the future of money even look like? Now that is something to think about.